All right, guys. Good morning, everyone. Welcome to day number 2. Okay. So before we start today, we'll just do a recap of what we've seen yesterday. So basically, yesterday we started with the introduction, pretty simple stuff. Then we went to the trading plan. We understood that it takes time to create a trade. It can take 1 to 10 days, but once you have your trades, you have your quality trade. It can last for a long time, can last for multiple days, weeks, months, all right? And then in our trading plan, we have the fundamental analysis, we have the market sentiment, we have the price action, and the technical analysis. Yesterday, we did the fundamental analysis. We started with the economic calendar. We understood how it worked, how to analyze the first part, the first reaction when a news comes out, when the data comes out. Then after part 1, we have part 2, that is a more rational behavior from the market. And so we understood that. We understood that sometimes when the numbers are good, when there's an opportunity, we can trade that second reaction, okay? And basically, the goal of the economic calendar was that we can trade a second reaction, like I said, or that we can accumulate information to form our fundamental idea later on. And also we can protect ourselves if we have trades running and we see that important news is coming up, all right? Then after the economic calendar, we jumped straight into the headline news. So we saw that the main website that we are going to use was Forex Live, and we have the other websites as complementary that we can go look for some more information. We understood that we do not trade the USD, the reason why we are trading these 6 currencies with gold as well. And you can trade other indexes if you want, you can trade other commodities. It applies to everything. It's just personal preference, but I explained why. Then we explained the personality of every currency, what's the correlation, what makes that currency move, what should we look for when we read the headline news, try to understand how it impacts the different currencies. Then right after that, we understood the principles that move the market, which is when the problems happen, when a solution happens, and if there's nothing that's going on, then the fundamental is less important. But the market is always going to react more when there's a problem than if it's a good event or a solution to a certain problem, okay? Then we did some simulation, how to interpret the fundamental information, basically positive, negative, the size of the situation, the duration of the situation, how is the market going to react, how are the institutions going to interpret that information. So we did all of that. We can do some extra research if we don't have enough information, but do not overcomplicate your fundamental because we're not analysts and we have to keep it simple and straight. Then we came to the final conclusion of our fundamental analysis, the creation of the fundamental idea. So you take 2 currencies, right? You always want to, take one that is strong, one that is weak, or the opposite, one that is weak, one that is strong. Keep it simple. You have your facts that you have collected in your fundamental bag from the headline news, from the economic calendar. That is giving you, what's going on with that currency. Then you can judge if the currency is strong because of, this fact and that fact. And at the end, you create that fundamental idea, you pair those 2 currencies, and then you have your direction of the trade. So that means that when you before you open the chart, when you have a market that moves with the fundamental, which is about 70–75% of the time, you must know the direction in which the currency is going to go before even looking at the charts, all right? However, when the fundamentals are flat or if they are mixed, that means that you have some positive and negative and they cancel each other out. This does not apply. It means that the fundamental is going to be less important, and maybe you're going to put more focus on the charts on the technical side. Then right after the fundamental, we went to the market sentiment. We understood what is a retail trader, what are the mistakes that are made mostly, and that you cannot make those mistakes, these 5 mistakes, if you want to become a profitable trader. Even if you make only 1 out of the 5, it won't work. You have to solve all the 5 mistakes. So if you recognize yourself in 1 or multiple of these mistakes, you have to work on them. You have to understand that you should not do them, right? Then we understood the difference between a retail trader, institutional trader. We understood that the financial institutions are the one who controls the market. They are the one with the big money. They're the one who moves the market. And their goal, of course, is to make money. And how do they make money? By tricking and taking that money from the retail traders. Okay, so now that you understand that the financial institutions are the leaders of the FX market, and actually in any market, you understand that you have to position yourself in the same direction as the institutional trader. Okay, you must always be positioned in the same direction as the institutional trader. How do we do that? We trade, we think, we sleep, we eat like an institution, okay? And by doing so, with time, you will build your experience, and you will get closer and closer to the same trades that the institutions are doing, and then you will get some positive return, positive results, and you will be able to grow your account, okay? And we understood that what's the difference between a winner and a loser in the market? It will be your capacity to follow the institutional movements. And that's it, okay? So the whole way of trading, your whole mindset and your whole way of trading, analyzing the information, fundamental, technical, everything should be aimed to understand and follow the institutional movements of the market. Why? Because they are the one who have the money, and basically they are the ones who create the movements on the market. And we were at this point. So our third pillar, which is the price action, all right? So what is the price action? Price action is the art of the study of the candlestick. So basically, by analyzing candlesticks and their movements in the market, we are able to understand how the big financial institutions are positioning themselves, and where are the retail trader traps, and what are the buyers and sellers doing. So by reading the chart, by looking at the candlesticks, it can give us a story about what's going on in the market. It can give us some context, and we can use that information to get a more accurate trade, to understand what's going on and follow those institutional movements, okay? And of course, very important for our technical idea construction that we are going to do just right after. So what is a candlestick? I'm not going to explain it. It's pretty simple. You should already know that. Candlestick principles. So we have 3 principles that the candlestick always follow, okay? Number 1 is when you have long wicks, okay? Number 2 is when you have big, large, full candlesticks. And the third principle is when you have large period of consolidation. So let's start with the number 1, okay? So when you see a long wick, it's equal to a heavy rejection, which means that the price doesn't want to go higher or lower because multiple reasons, okay? The price doesn't want to go higher or lower than a certain level. There's a heavy rejection, which means that the price bounces on something, okay? And why does it bounce on something and creates that long wick? We have 4 choices. Either we have reached the take profit of a financial institution. So the financial institutions were already in a trade, they reached their take profit, now they're closing their trade at a certain specific level, and that creates that heavy rejection, which creates that long wick. That's choice number one. Either there's an agenda that the financial institutions want to respect. So, for example, they don't want to break a certain level because they want to keep the price in a certain range, because they have been planning something, they have been planning a trade, and they need the price to stay at a certain level for them to enter that trade and execute it. That's number two. Either it could be also a retail trader trap. Okay, we can also call that a stop hunt. Okay, so now that we know that the institutions are hunting the retail traders, sometimes they're going to manipulate the price and basically do a trap. You will see a heavy rejection because it touched all the stop losses of the retail traders, and then you will see the wick, which is the correction after the stop hunt. Or the last choice, it could be a fundamental event. So if something happens, if a big news comes out on the economic calendar, you have part one that is very negative, then part two, let's say, is the opposite, it's very positive, then you will have, a reversal, you're going to have a rejection, you're going to have a long wick. So it's 1, 2, 3, or 4. Those are only the 4 choices. So each time you see a long wick on the market, the story that candlestick with the long wick tells you is that one of these 4 events is happening. Either we have a take profit, either there's a planning and agenda from the financial institution, either it was a stop hunt, or it was a fundamental event. And how do you know which one it is? With experience and just elimination. Okay, so if there's no fundamental event, you can easily look it up. If there's no fundamental event, well, this one is gone. Then the take profit, you would have to see the previous movement. If, for example, we have a nice uptrend, we have a nice downtrend, we reach at a certain level, we have a long wick, that might be take profit, might be agenda, stop hunt. Okay, we'll do some more detailed example just afterwards. But we're going to be able to understand which one of the 4 choices it is when we see that long wick, that long rejection. Okay. Then principle number 2 is when you see full, big, large candlesticks with little wicks or absolutely no wicks at all. Okay, that could be multiple things. Okay, as well. First of all, it's always when a big position is entered in the market. Okay, when you see big candlestick, means the institutions have opened a big position. But why have they opened that big positions? There's 2 choices. Okay, either the financial institutions have entered in their trade, so they opened some new position to execute their idea, their trade. So the price is pushing, the institutions are now in the trade, or they are manipulating the price to trap retail traders. So basically a stop hunt. Once again, it can take shape in form of a long wick if you see it afterwards, but if you see it live in front of your eyes, you're going to see a big, large, full candlestick, and it could be a stop hunt if there's no reason for that movement to happen. Let's say you look at your fundamental, you look at your technical, and the movement is purely random. You don't exactly understand why that movement is happening. You don't seem to find a reason for the institutions to be making that sort of trade. Then it's a manipulation, and it's a stop hunt. Okay. And then the last principle is when you see large period of candlestick consolidation. Okay, so basically when the market is in a range, it consolidates. We have multiple candlesticks just consolidating. What does that mean? What story does it tell us? It's equal to financial institutions creating their game plan. Okay, they are either gaining time, they need time to either collect the information, create their plan, find the take profit, define their stop loss, find the entry point, So basically, they're just creating their game plan. They need the price to stay in a certain level so they can have the best entry point. So that's why you see some consolidation sometimes. Or choice number two is that they are accumulating or distributing their position. Okay. What is accumulation, distributing? Accumulation is getting in a trade. So they are getting in the trade. So basically they enter the trade. I should maybe write that instead. So accumulation, they enter the trade. They add positions. And distribution is the opposite. So they exit the trade or they remove positions, because they don't need to exit 100% of their positions. Okay, so accumulation, they are entering a trade, so it takes time to accumulate because they have a lot of money. They have to open multiple, 1,000, 100,000 lots. Okay, or they're adding position to their existing trade. And distribution, they are closing their trade either 100%. If it's a full exit, they're closing everything. Or if they remove some position, they might close, I don't know, 10%, 20%, 50% of their position. And of course, that takes time. And they want to keep the price in a box like this one so they can have the best, price. Because if they start just exiting their trade, removing their trade, or, adding the trade is the same thing. Since they have so much money, the price is going to move. It can go up or it can go down if they don't do it in a controlled fashion. So that's why they are going to use usually robots, algorithms, to keep the price in a consolidation. And maybe they exit a position here, they exit a position here, they exit a position here. And then at the end, they removed, for example, let's say 40% of their position in that range, and then the market keeps going. They took some partial profits, for example. Okay, so those are the three candlestick principles. When you understand that, you can look at the charts, you can look at the price action, and it tells you a story. It gives you information that you can use, like I said, to make a better trade and to understand what everyone on the playing field is doing. Okay, so let's do some examples. So here, for example, we have the example for the principle number one. Okay, we'll do one example of each. So for principle number one, we said that when we see long wicks, it can mean four things. We said take profit, agenda, stop hunt, or fundamental event. So here we see that we have some long wicks here. Here we have this one, which is the principal one, the very long wick, okay, that I can see, in the price action. Here I have some smaller wicks. Here I have another one. Here I have some on the top, but let's focus on the one on the bottom, okay? So if we look at the main one, this one here, and we try to understand, is it a take profit? Is it a stop hunt? Is it a fundamental event? Or is it an agenda, okay? Here I would say, maybe it's a fundamental event. We can't really know by just looking at the chart. We would have to look at that moment if something was going on, okay? But if we remove that that choice and we look at three other choices, this is not, I would not say that is an agenda planned by the financial institutions, because the movement is too large, all right? Here you see that, this wick and this wick and, all the 3 weeks over here, they're pretty much in the same range. And these wicks, I would say it's based due an agenda. So the institutions don't want the price to go lower, maybe because they are looking for to add position, to enter some new trade, and for the price to go higher. Okay, but this movement here, this big red candlestick that is huge, with this long wick, that's not an agenda because the movement is too large. Okay, it's too big. When you see something, when you see the price that it doesn't want to go through a certain level because there's been an agenda from the institution, it will be more reasonable, smaller like this. Okay, so then we have two choices left. Either it's a stop hunt or a take profit. Okay, a take profit will usually happen when you're at the end of a trend. A big take profit like this, you would need to have like a big downtrend. Maybe you would have this big wick, maybe a bit of consolidation, and then maybe we go back up. Okay, so this is not the case here, because if you look before, there's not a lot of movement before. We have like a period of consolidation. All of this is a big period of consolidation. There's no momentum in the market, so it's surely not a take profit. Okay, so what's the only remaining choice? It's a stop hunt. Okay, it might be a fundamental event. Like I said, I don't know. It's either a fundamental event or a stop hunt. Okay, so maybe if you don't look at the future, you don't know what's going to happen. Maybe in this instance right here on this pullback, many retail traders started to go long for whatever reason. Okay, then they had all their stop losses in this area right over here. The institutions, let's say, they planned to go long, okay, for with their fundamental idea, with their technical idea. But they needed some liquidity. They pushed the price very far. They stopped out everyone. Every retail trader in that trade got stopped out, even if some retail traders, entered in this movement here, this up movement here, and they put their stop loss here, here. They got stopped out. And then the market had a bit of consolidation, and finally we went up. Okay, so just by looking at the candlesticks, I can start to analyze, understand what's going on. Okay, does it mean that you're going to be right 100% of the time and you're going to understand 100% of the time? Of course not. Okay, but it gives you an edge. It's something that you need to know, and sometimes it's going to make the difference between a bad trade and a good trade if you understand what's going on. Okay. Here, let's do another example for number one. This one is pretty easy. So here we see this long wick right over here. So as a trader, you look at that, you look at the price action and you wonder, what does this mean? Okay, why is this long wick here? What are the financial institutions doing? Okay, and this is a very simple case. This is just a classic stop hunt. Okay, a retail trader trap. So we don't know what happened before on the chart, but we can expect the retail traders to be loading some positions to go up, having their stop losses here at different levels. The institutions are want to go long, so basically they need some liquidity to enter the market. So for example, let's say HSBC wants to go long on this trade, and they need to open, let's make it a round number, let's say they need to open 100,000 lots. Okay, so they want to buy 100,000 lots. Okay, to buy 100,000 lots, it's a lot of money at first, but you also need on the other side, when you click that button, when you press that 100 lot buy, on the other side you need the same number of lots, but on the sell side. Okay, so if you're buying 100,000 lots, someone has to be selling it to you. So that's where sometimes the institutions have some liquidity problems, because if on the other side, instead of being 100,000 lots, they look at the volume, they look at their numbers, and there's only 50,000 lots who are on the sell side. Okay, here we have a problem. Only half of their positions are going to be filled. Okay, so there's a 50,000 lot, okay, that has to enter, that the institutions don't know how they're going to execute it, put it in the market. And that's why they will do something like this. They will do a stop hunt, okay? Because by pushing the price against the retail trader, each time the stop losses are triggered, it adds, if the retail traders were buying here, when it touch their stop losses, they are selling over here, okay? And that selling, that might be that plus 50,000 lot that they need, okay, to complete that 100,000 lot. So that's 50,000 lot that's added in this stop hunt is now filled here. And then you have 50,000 lot that they entered, let's say, normally, and they have that 50,000 lot that is from the stop loss hunt. And then now they have the 100,000 lot. Everyone is happy. They're making money on the movement, and then the price explodes to the upside. Okay, so that's the principle between in a stop loss hunt, and the principle of a liquidity problem, and how sometimes they have to manipulate the price to enter their position because their position is just too big. Okay, depending on the currency, depending on the time of day, depending on the setup, depending on the volatility. Sometimes they're going to have difficulty entering 50,000 lot. Sometimes it's going to be easy to enter 100,000 lot. Maybe sometimes they want to enter 500,000 lot. It's going to be a bit more difficult. They're going to have to create a bigger manipulation. So the size of the stop loss hunt will be in proportion to the liquidity they need to enter their position here. Okay, the bigger the number here that we don't know how many lots they want to open, but the bigger the stop loss hunt, the bigger usually they are going to open their position, the more liquidity they need, which means that the movement after the stop hunt, so when the stop loss is finished and the market goes, the bigger the stop loss, the bigger the movement is going to be afterwards. All right, so just by looking once again at the price action, looking at the chart, we can understand all these concepts, and it can give us some information, an edge to understand what's going on. So let's go to example for the principle number 2. Okay, so number 2, we said when we see big, large, full candlestick, the price is pushing and pushing and pushing, like this one here, like this big red candlestick. Even here, they took some profit. But we said it's based on, there's two choices for this principle. Okay, we have either they entered their trade simply, or it's a retail trader trap. So it's either a stop loss hunt, or they enter their positions. So if we go back, here we can simply see that in this example, they have entered their trade, they have entered their positions, and here also they have entered their position. So it's pretty simple, and here they took some profit at the end. So you see here there was the take profit, and that's it. Okay. So now you understand that the institutions are in the trade, okay? Now, very important, you don't enter a trade when this happens. You don't enter in the middle of it. This is just a way to look at the price action and have a confirmation if you entered in the trade before. So let's say you entered somewhere here. For whatever reason, whatever fundamental idea, whatever technical idea, and you were long, okay? You put your alerts, you see what's going on, and as soon as you see these big, full candlestick, nice and juicy, that it gives you the satisfaction that you hopped on the institutional movement. And if we go back to when we talked about the market sentiment, and I said, what's the difference between a winner and a loser in the market? It's your ability to follow institutional movements. Well, as soon as you see these types of candlesticks, it's a win from your part, okay? Because you've been able to predict and enter on an institutional movement. So this is some sort of confirmation that your trade is good. You have nothing to worry about. You can put your stop loss to break even. Basically, you would already have your take profit and everything laid out at that point. But this would be your ultimate confirmation. You know that your trade is good, and basically it's a clear win. Okay. Now let's do an example for number 3, principle number 3. So we said number 3 was the principle of consolidation. Okay, when the market is in a range like this one here. Okay, and we said they are gaining time. Okay, or they are entering. So they enter, exit the trade with accumulation and distribution. Okay. So in this case, with this big range, just before this big consolidation, what do we have before? We have this big, beautiful movement, this beautiful downtrend. So the institutions have been, in this trade, they entered here, 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 here. They've been pushing the price, pushing the price, pushing the price. And then here was a take profit. They got out. Okay, very happy with their trade. Okay, but did they get out all the positions that they accumulated over here? Of course not. Okay, let's say this whole period of time, let's say they accumulated 1 million lots short. Okay, do you think they can close 1 million lot short at the same time in just one click on their computer? Absolutely not. It's too big, it's too much money. Okay, so when it reached the take profit, maybe they took, I don't know, let's say 100,000 lots. Okay, so that's 10%. And let's say they know that their trade is over. The remaining is 90%. Okay, 90% that needs to be distributed, that needs to exit from their account, their running account. So to close that remaining 90%, that 900,000 lots, it's going to take time, and they're going to have to keep the market in a certain price. You're going to have to play with it, and they use advanced softwares and robots and algorithms to do all that work. And basically here, they might close 50K lots here. Here they might close, 20K here. Then here, oh, they had a good close. They close 100K and so on and so forth. You get the idea. And at the end, they liquidated 100%, or let's say 90%, whatever the proportion that they want to close is. And then the market, let's say, goes the opposite way. Okay, the other way, and they start to accumulate to go the other way. Okay, so when you see big period of consolidation, and it is, after a big uptrend, big downtrend like this one, that they are exiting their trade and maybe accumulating for the next one. So if you see the institution starting to exit their trade, you might ask yourself, why are they exiting their trade? Is there something that I don't know? Is there something that I should look at? And that gives you a clue that you can look maybe at the fundamental. Is there a shift in the fundamental idea? Is the technical at a very critical level? Is it a historical level? What is going on? And sometimes that clue, that information is going to give you the edge to make that next trade, maybe to go long here. Maybe you would find an entry here and you would go long if you wanted to, and you understood why. Okay, so that's price action. That's just looking at the chart, looking at the principles, and basically understanding what's going on with the plays of the market, stop hunt, take profit, consolidation, everything. And that gives you sometimes, clues and information to what is going on in the market, and allows you to find a good trade. Now, the candlestick patterns, I'm not going to spend much time on them. They are based on the principles. They're very simple, so you can read them at home. It's not very complex, okay? So with time and experience, you will be able to understand better the relationship between the actors in the market and how the candlestick moves. Does it mean that you will understand every little price action and every little movement of the market? Of course not, okay? But you will be able to understand the big, price action clues if you look at the chart correctly, okay? And that comes with experience. In the beginning, if you're not too sure of what's going on, give yourself some time. This comes with experience, okay? Follow the principles and the patterns at first. They will get you in the right direction. But, okay, important, sometimes the movements on the market are very complex. It can happen that multiple principal pattern fuse together to create something new and unique. And when I say new and unique, I mean a certain new and unique principle, like let's say if one which is a long wick, and number three, which is consolidation. Okay, let's say sometimes you're going to have a long wick plus consolidation, and you're going to have something special. Okay, you're going to have something that is a fusion between the two, and you're going to be able to add them together, understand what's going on. Why is there a long wick and why is there a consolidation? There's a long wick because they took their profit, and now there's a consolidation because they are exiting, they are distributing the rest of their position. So just like the example we just did before, okay? So don't just take the principle separately. Sometimes they can be at the same time together. You have to use your creativity and understanding to come up with a solution on those occasions. What I mean by a solution, just an understanding, see what's going on, understand what the actors in the market are doing. And that's it for the price action. All right. So if you guys have any questions regarding that, now is the time. What if it goes down, consolidates, and then continues? Did institutions close a few positions and then let the other run? So let's say you have a movement down, you have some consolidation, and we keep going down, right? This means that they took some partial profit. So let's say they had their 100% position. Maybe here they closed 20% of their profit, and then the remaining is going to be that 80% that's going to push. And at the end, they're going to distribute, play with the price and go back up. So yes. Which time frame do you use the most? On which time frame do you look at price action? Usually it's going to be 4 hour or 1 hour that we're going to look at the price action. Okay, the 3 time frames that we're going to use, we're going to see them in a technical analysis, but the 3 time frames are going to be daily, 4 hour, and 1 hour. Okay, daily price action is a bit too big, so price action is going to be 4 hour and 1 hour. In periods of consolidation, do you plan when you might see the next move? Meaning if you see an upcoming major news, you know when you might see the next move. Yes, when you are, we're going to see it in the technical analysis, but I'll just answer it shortly. Briefly, I would say. Yes, when there's a consolidation and you don't know where the market is going to break out, if the fundamental is clear, you know in advance where the market is going to break, if it's going to break to the upside or the downside, because you make the link with the institutions. What are they doing? Are they adding position? Are they exiting position? Are they doing both at the same time? But yes, the fundamental is going to tell you what's going to happen after that consolidation. Do we know when a consolidation comes to an end? Never. You never know. Okay, you never know that last candle. Okay, actually, there's an exception. Okay, listen very carefully. That's the only exception that you know, but doesn't happen all the time. So let's say you have a movement going down, right? You have a period of consolidation for a long time, and you're like, man, how do I know when that consolidation ends? Let's say you see a big stop hunt, and the price does this, you know the consolidation is over, because you know that the retail traders, let's say they bought here, they put some stop losses here, you know the institutions push the price down to get some liquidity, and they push the price down to go back up. Okay, it's very simple. That's the only case when you see that the consolidation is over, is that when there's a stop hunt. But other than that, you don't know when it's going to be over. Do you leverage other types of candlestick? Nope. I never looked at any other type of candlestick. It's not necessary. We're not scalping or doing small day trades, so it's not necessary. What if there's a downtrend and the market reverses from the middle from nowhere? Does it mean that there's a strong surprise fundamental released? Yes, because it means that the institutions did not have time to close all their position. How do you differentiate a breakout versus a stop loss? Well, you don't trade on a breakout, right? You don't trade on a breakout, and that's not because it breaks something that you trade. We're going to see it on the technical analysis section. But the stop hunt usually is going to be is going to take less time. A stop hunt might take between, let's say, 30 seconds to 10 minutes. Breakout can last, multiple hours. Could be 2 days to break out something. So stop hunt is very quick, very sharp. It goes and come back. Breakout, it can go fast too, but usually it's going to be way slower than a stop hunt. And in any case, you don't enter on the breakout. You never do that, because sometimes you don't know if it's a breakout or stop hunt. Sometimes that the market is a bit ambiguous, let's say. What would be the decision-making criteria for placing a limit order versus market under either of the three scenarios combination? What we've seen with the price action has nothing to do with how we are going to trade. Okay, the price action is like, in your head, it should be the same thing as the market sentiment. Okay, it's a concept. It's something that you are going to use all the time, but you do not use that to make a trade. You don't trade based on just a consolidation without any reason. Okay, you need a fundamental idea. We're going to look at the whole technical analysis section, but when you look at the chart, the goal of the price action is only to understand what's going on, take that information, and then with your technical analysis, you're going to refine your understanding and refine your entry points. And that's it. For large-bodied candlestick, you said do not enter in the once multiple large candlestick have been formed. Why? Because it's too late. When you take the train, you enter at the station. You don't jump in a train while it's moving. Okay, you have a lot of chance to hurt yourself. Let's keep it at that. How large are stop hunts usually? 20, 30 pips or 70, 100 pips? It depends on how much the banks need liquidity. The bigger stop hunt, so the more pips it is, the bigger liquidity they need, which means that the move after the stop hunt is going to be bigger. So sometimes it's going to be 30 pips, sometimes it's going to be 50, sometimes it's going to be 100, and sometimes it could be 200. Okay, if it's something crazy, you can have a stop hunt of 200 pips, and those are very rare, maybe once a year or once every 2 years, but it could happen if they need the liquidity. But the stop hunt is going to vary depending on the liquidity. What is the best way to backtest this? Well, you can just open any chart and start looking at them in 1 hour, 4 hour. You're never going to have a perfect answer because you don't know what was going on in the past. But honestly, the best way to go about it and understand it is just to look at it on a day-to-day basis, and that's it. And with time, you're going to build your experience. Can they cover 100 pip plus move in 10 minutes? Absolutely. They can do it even in 1 minute if they want to. They can do 100 pip down, 100 pip up in less than 1 minute. because there's a lot of liquidity. If the retail traders are long on a trade, there's a lot of liquidity. So there's no problem of going down fast and going back up, since there's a lot of money here that is waiting to be, just snatched away. All right, so that's it for the questions. Let's continue with the technical analysis. So we said that in our technical analysis section, we have 4 sections inside the technical. We have the market structure, we have the market trend, we have Fibonacci, and then at the end, we have the divergence, okay? So market structure, support, resistance, very simple. I'm not going to explain that. Everyone should know that. However, very important, what's important with supports and resistance is that they are zones, okay? They are not just straight lines. Technically, they are zones, they are boxes that start from the end of the candlestick to the end of the wick. What do I mean by that? Okay, it looks like this: support, resistance, or zone. So for example, let's take this one here, okay? This resistance here, okay? This is a resistance. It starts from the end of the candlestick, which is here, right? That's the end of the candlestick. And this is the end of the wick. And wick, and that's end candlestick. So this whole zone, okay, that's the resistance. It's not, the resistance is not here. It's not just a line. It's the whole zone. Same thing here. Okay, we have a certain level that we have, some support. Okay, so this is a support level. However, the end of the candlestick is actually right over here, of this one here. So that's the end of the candlestick. And the end of the wick is right over here, the lowest wick of that support zone, in that area around it. Okay, so you don't have just to, divided in two. You can make, a support here, a support here, but actually they are the same support. So you can fuse them together, even if it's 2 different candlesticks, even if they're a bit, they have a bit of space between them, it's okay. But you have the end of the candlestick, and here you have the end of the wick. Same thing here, end of candlestick, end of wick. So sometimes you have big zones, sometimes you have small zones, okay? Now, now that we understand this, does it mean that on your chart, you are going to put, many bunch of zones like this each time you see a support and resistance? Absolutely not. Why? Because your chart is going to get too crowded. Okay, you can put so many of these zones and these boxes. Your chart is going to be too crowded. Okay, so instead of putting them all like this separately, okay, later on we're going to be able to put zones on the important levels, but you will always keep in your head, in your mind, that every time you see a support and resistance, you will see it as a zone in your head with your eyes, but you don't need to draw it on your chart. Okay, it's just a concept that you need to understand once again. So I don't want to see your chart full of zones like this for every little support and resistance. Okay, it's just like I said, a concept that you need to keep in mind and always see the support and resistance in this fashion. Now, if we get, a bit more detailed with the support resistance, okay, we need to understand how is a support or a resistance created. Okay, so support resistance is the same thing. I'm going to do one explanation for both since it's the same thing. So the support is created in 2 parts. The resistance is created in 2 parts. It's the same, like I said. The first part is the sellers in the market closing their positions and taking their profit. Okay, so part 1, okay, it's always take profit from either the sellers or the buyers, depending if it's a stop loss or not a stop loss, a support or a resistance. Okay, and then part number 2, the second part is new buyers coming in the market and opening new fresh position. Okay, So part number 2 is new positions from either the sellers or the buyers, once again, depending if it's a support or resistance. And that's it, very simple, okay? Always part 1 and part 2, okay? Depending on the market condition, these two parts can happen at the same time or be one after the other, okay? So maybe the buyers from part 2 will wait for the sellers, from part 1 to close all their position, okay? Or it can happen at the same time. Sellers and buyers will create the support resistance at certain specific structural levels in the market. It is not random. There has to be a motivation for someone to close their trade or open a new one, okay? Maybe if it's your first day on the Forex market, you're going to open or close a trade in the middle of nowhere, okay? But most of traders, even retail traders, need some sort of motivation to close and open the trade. So the support and resistance will always happen at certain structural levels that we're going to see afterwards. And when we reach those structural levels and that support and resistance starts to take life, we need to understand that it's made of people taking their profit first. Okay, so usually that's always number one. And, secondly, okay, you have new buyers or new sellers coming in the market. So for example, let's say this support here, okay? First part is the sellers closing their trade. So sellers are TP, okay? The sellers from where? Well, from this whole movement here, okay? Sellers. Here, they decide to take some profit. Then part 2 here, it's buyers, okay, who are entering a new trade, okay? So they're entering a new trade over here. They're adding positions in that support zone so that they can, go and do their trade. So it's the same principle as what I said before, distribution, okay? So distribution, and this is accumulation. Distribution, we exit, we close our trade, we take our profit. And accumulation, we enter in a trade, we add positions. So it's basically this, the saying stop loss, and not stop loss, support, resistance, saying, take profit, or, entering a trade, saying distribution and accumulation, it's all the same thing, okay? Those are all words and concept that means the same thing, but explained in different forms. So accumulation and distribution, this is the mechanism behind supports and resistance. Accumulation zone is where traders, institutions are opening, adding position to the market. Okay, they're adding a buy or a sell. They can accumulate to sell, or they can accumulate to go long, to buy. Okay. And distribution zone is where traders, institutions are closing either fully or a portion of their position in the market. They are removing a buy or a sell from the market, okay? Here they add, here they remove. Okay, distribution, accumulation. When you add, that's the part 2 of the support resistance, and when you remove, it's the part 1, okay? Like I said, it all means the same thing. Now, this is very important, okay? The bigger positions that are injected in the market or removed from the market, okay? So the more money is added or removed, the longer the accumulation distribution period will be, okay? Why? Because there's more money, so it takes time to add all that money in the market or remove all that money in the market, from the market. Example, for big financial institutions who are opening, let's say 100,000 plus lots, it can take them days, weeks, months, if they have a very large position, to accumulate or distribute their position. Okay, this is why sometimes you have big long support resistance and sometimes you have shorter support and resistance depending on the length and price variation of that support resistance. So if I have a support like this, okay, let's say a small support zone like this, or if I have a big support like this, okay, it doesn't mean this, it doesn't mean the same. Okay, so this is a small support and let's say this is a big one. Depending on the length and price variation of a support resistance, you can know, not now, but know the size of the institution's position. Okay, so the bigger it is, the more money is moved around, and the smaller it is, the less money is accumulated or distributed. So the bigger support resistance, okay, the bigger the money that is put in the market or removed from the market, which means the bigger the movement is going to be afterwards. Okay, and actually, when you have that big of a support, you know, big support, honestly, it's the same thing as a consolidation. There's no difference between the two if it's big enough. The concept, they like fuse together, and a big support or big resistance, they become consolidation. And when I say bigger support, I mean, like I said, right over here in length. So in length, so this is the, right from here to here, that's the length of time. And from here to here, that's the price variation, the range. Okay, those are the two concepts. Okay, so depending on the length and price variation, the bigger it is, because sometimes you're going to have maybe a small support, but it's going to be very long. Actually, that's going to be very rare. Usually, it's going to be the opposite. Sometimes you're going to have, you know, something like this. Okay, long wicks, long candles, and then breaks out, for example. Okay, but it means that there's a lot of money inside the market. So let's do an example, okay, a small analogy so we can all understand that concept properly, okay? So let's say I have my friend Bob, okay? I've been friend with Bob since, you know, I was a small kid. We grew up together, and now Bob works for Apple, okay? He moved to China and he works in the main Apple factory that produce, you know, all the iPhones nowadays, okay? And each time, every week, I call Bob and I ask him, you know, how's the job doing? You know, any news, something you want to, you know, tell me about your life, you know, what's going on, just taking some news each week since he's my best friend. And this week when I talk to him, he tells me, man, Sammy, at work in the Apple factory, the workers are not happy. I feel the tension building up. And some workers are talking about, you know, burning down the factory. They're not happy with their job. They're not happy with the way they are treated by the company. They're working long hours. And yeah, I think there's a group that's coming together. They want to burn down the factory. I say, oh man, Bob, that's some bad news indeed. Do you think it's going to happen? Do you think they're going to burn the factory down? So he says to me, well, I don't know, but it keeps building up. I'll keep you updated. Okay. So that's the situation. That's the, let's say, the fundamental context from my friend Bob. Okay. So fundamental context from my friend Bob. And I keep, I keep calling Bob, you know, every week we discuss and it builds and builds and builds. And one day he tells me, man, in the next few weeks, it's going to happen. They're going to do it. So I say, all right, I'm a trader. I'm, you know, I know how to analyze the fundamental. I know how to make a proper trade. So why don't I make a trade based on this fundamental, you know, idea, this fundamental context? So I tell to myself, well, if they burn down the factory, okay, if the factory does not exist anymore, the production of the iPhones are going to stop. And what will happen to the value of the the iPhones that are in the market, in circulation, well, they're going to increase in value and they're going to be sold, resold at a very high price. Since you cannot order one, you cannot buy one from Apple since they stopped the production. So in that context, I say, all right, let me take $100,000, okay, and go buy some iPhones. Let's say each iPhone, okay, it's $1,000 each. So I walk in the Apple store and technically I can buy, right? How many iPhones can I buy? I can buy 100 iPhones. So I walk in the Apple store, I talk to one of the employees there and I tell him, man, hi, I'm looking to buy 100 iPhones. What do you think he's gonna say me? He's gonna say to me, man, I'm sorry, we cannot sell you 100 iPhones today. There's a limit per customer, and even then, we don't have 100 iPhones in the back store right now. We only have 25. Okay, so I say, all right. So how much can I buy? How many iPhones can I buy today? And he says, let me talk to my manager. So he brings the manager. I talk with them, and we cut a deal that today I can buy 10 iPhones. Okay, so on day one, the manager made an exception for me and allowed me to buy 10 iPhones. Okay, and he told me, Sammy, you can come back every day. Every day there's a new truck coming in. We have fresh iPhones coming in every day. So you can come and buy 10 iPhones every day. Okay, so from day one to day 10, what am I doing? I'm going to the Apple store every day and I'm buying 10 iPhones so I can get that 100 iPhones. So what's that period of time? That's accumulation, okay? I am entering in the market, I'm adding positions. And since my position is so large, so big, it takes time because there's restrictions, there's limits. I cannot just walk in the Apple store and buy 100 iPhones at the same time, okay? Takes me 10 days to go and accumulate those 100 iPhones. Now I have my $100,000 invested in those 100 iPhones. So I wait a little bit, and one day I wake up, I look at the news, and indeed it happened. The Apple factory has burned down. The workers are angry. They burned the factory down last night, and now the production of all iPhones has stopped. What happens to my $100,000 investment with my 100 iPhones? That are $1,000 each. Now, in 1 day, in 2 days, in 3 days, I go look at the resale price since now that the production has stopped. And each iPhone, let's say, is now worth $5,000. Each iPhone is now trading for $5,000 on eBay, on Craigslist, on Facebook, everywhere. It's $5,000 for an iPhone. So now my $100,000 investment is now worth $500,000 investment. Okay, what's my floating profit? So my floating profit here is 400K. That's floating in the air. And if I don't sell any iPhones, well, it's just floating. It doesn't come to life. So after the accumulation, now what is the last part is going to be the distribution. It's me taking my profit. Distribution, I take my profit. So I start selling iPhones. Can I sell 100 iPhones at the same time? Probably not. Okay, so I sell maybe 5 to someone. I sell 1 to someone else. I sell 2 to this guy. And then I sell 10 iPhones to this shop that wants to resell them as well, and so on and so forth and so forth. So basically, I sell all of them, okay, and it takes me, let's say, 8 days to sell all of them. That's the distribution period that I liquidate all my position, all my iPhones, And at the end, let's say I sold them all around 5,000. At the end, I get my 500,000, which means that I have a profit of $400,000 that I made based on this fundamental idea from my friend Bob. Okay, so that's how it worked. Okay, so it's a simple example, it's a bit funny, but it gets the idea across. Okay, you have the accumulation period. It takes time to buy all the iPhones, to enter all the positions in the market. That's the problem that institutions are living day to day, since they have so much money. And once they have all their position, the price has moved, it reached their target, they need to now distribute those positions, take their profit, and that takes time. That takes days, weeks, months sometimes. And at the end of that distribution period, they have their profit. And then they do a next trade and a next trade and next trade, and so on and so forth. Okay, so that's the concept of distribution and accumulation. Okay, so each time you see support resistance, it's the same thing that I said before. This is distribution, accumulation. All right, distribution, accumulation, distribution, accumulation. Okay, they're closing a bit and they're accumulating for the correction. Okay, now large support and resistance. Okay, so when I say large, I mean, you know, big support and resistance like this, have more probability of being a market correction or a trend reversal. Okay, market correction or trend reversal, because we have a profit taking and we are adding some position. This is why they are longer, because they have both. Okay, both part one, okay, and part two is happening at the same time, or one after the other, but it takes time, and that's why you see bigger support and resistance. Now, when you have a small support or resistance, both in terms of time and in terms of price variation, they have more probability of being a position adding level for the continuation of the trend. So this means that the institutions did not take profit and just are accumulating for the continuation of the movement. And consolidation, basically the same thing as this one, are nothing more than large levels of distribution and discrimination, just like the large support resistance. It's the same thing. Okay, so consolidation, large support resistance, like I said, the concept, they fuse together and they become one. Now, warning. Large supports and resistance can't be accumulation only zones, but sometimes the small support, so these guys over here, sometimes, very, you know, occasionally, not very often, they can be distribution and accumulation at the same time. So sometimes the small support and resistance can behave like a big support and resistance, okay? But not very often. I would say maybe 5-10% of the time. So it's just good to know, but you can, you know, you don't need to put all your focus on that. So let's do an example, a concrete example, so we can understand. Here we have a difference between a large and a small support. Okay, so here I have large support, here I have baby support. Okay, you see visually they don't look the same. Okay, this one is very small in terms of time and very small in terms of price variation. This one is very long and very, you know, there's a lot of pips of variation here. Okay, what's the difference between the two? Here we have distribution plus accumulation. So basically we are closing trades and opening new one. And here we have only accumulation. There's no distribution. We are just adding a position. Since we are just adding a position, it means that the institutions are adding a position to continue the trend, continue the movement. So this is a continuation, right? And this one could be either a correction. Okay, so it might be, you know, just a big correction and we continue. Okay, correction may be in this form and we continue. Okay, it's a correction. Or it could be a reversal, like in this case. So in this case, it's a reversal. Okay, we came down, we go up. We came down, big support, we go back up. So it's either like that, or we go down, big support, correction, and we continue. In the case of a small support like this, which is just accumulation, never you're going to see the market going down, like a baby support, and then the market goes up. This will happen maybe 1% of the time. Is going to be very, very, very rare, okay? Most of the time, it's going to be, you know, bit of consolidation, correction, and then here you will have a baby resistance, and then it will continue. So the baby resistance here, it's accumulation to continue the original movement. Here, consolidation, same thing, like I said, distribution plus accumulation, reversal or correction. Now, since a distribution can be a correction or a trend reversal, okay, how can we know? Like, if you don't know the future and you have a big support like this, how do you know if it's going to be a reversal like this, or if it's just going to be a correction for a continuation, okay? So basically, what's the difference between these two scenarios? They basically have the same big support. You know, it's either a correction or reversal, but how do you make the difference, okay? The only way to understand and to predict where the market is going is to look and understand your fundamentals. You will then be able to understand the motivations and the plan of the financial institutions, and you will be able to predict their next move in the market with a high accuracy. The better the fundamental idea, the better you'll trade, knowing whether support, resistance, or reversals or correction. And the better you'll know in which direction the consolidation are going to break out, just like I said before. So what's the difference between number one and number two, between the reversal, right, the reversal or the correction? The only difference is the fundamental context. Okay, that's the only information that can give you an edge. So in this case here that you have the reversal, when you have this big support right over here, you need to study your fundamental. Okay, you need to understand what caused this movement. Okay, so here you have some explanation, blah 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 blah. We were in the uptrend because blah 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 blah. Okay, then at the end of the support, you need to ask yourself, is this blah blah still available, still relevant? Is it still applicable to the market, or has the fundamental shifted? When there's a shift in fundamental, it means that this blah blah is not relevant anymore, which means that it's going to be a reversal with some new fundamental information. Okay, that's going to, you know, cause that movement. In the case here, you have once again that fundamental context, that blah 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 blah. This downtrend is caused because this, and that. At the end here, you look at the fundamental, and this fundamental, you know, context is still valid. Nothing has changed. There's no new information. Let's say there was a problem. The problem is still there, or even the problem is getting worse. And you see something like this, you know, it's not going to be a reversal because the problem is still there. The fundamental context is still happening. There's no reason for the market to reverse and, you know, go back up to its previous level. Okay, so you know automatically that it's a correction and that the blah blah will continue. The fundamental context will continue to push the price to the downside. So this is a continuation, okay, because same fundamental, nothing has changed. Okay, this is The only way you can have an edge and understand what's going to happen before it happens. Okay? Sometimes there's no fundamental. Let's say the fundamental is mixed or flat. Nothing is going on during that period of support, resistance, or consolidation. Then in that case, you have no edge and you cannot know if it's a reversal or a correction. So you do not trade. You can only know when there's fundamental information, when there's a fundamental context. If there's nothing, well, you're not going to invent something, right? You just can't do anything. That's the situation. That's the market situation. You cannot know if it's a reversal or a correction. You're not supposed to know every little movement of the market. So in that case, you do nothing and you see what happens. But like I said, 70% of the time, you have the fundamental backing you up and you can understand basically what's going to happen. So for example, here, we have big support, big support. Here we have correction, and here we have reversal. How do I make the difference between these two? Once again, fundamental context. Here it was the same situation, same fundamental, and here there was a shift. That's the difference between the two. Since it's the same, the institutions are going to drive the price. They're going to keep pushing in the same direction. And here, when there's a reversal, since there's a shift, there's no reason for the price to go lower. So we exit our position, we reverse, and basically the market goes back up. And that's it for accumulation distribution. Okay, support resistance. Is there any questions regarding that section? No questions for that, or just writing down the questions? Do you think it's the same concept, but for indexes, it applies to everything? Okay. Since the Forex market has more money, it's more liquid, it's going to apply better, and indexes have a bit less money. But yes, it applies everything we see in this course. You can trade anything with it. Does this concept apply to smaller time frame candles like 15 minutes? Not really, because the institutions are not trading in 15 minutes. Sami, what about those support resistance in which the price moves away from it, then comes back to it? What does it mean in terms of institutions? What do you mean by moves away from it and then come back? So let's say I have a movement like this, I have, let's say, a support. And do you mean like go up and go inside like this? This is probably just a stop hunt or manipulation, false breakout to bait retail traders. Double top, double bottom is a resistance. It doesn't matter. It doesn't matter if it's a double top like this, okay, and it's a reversal. This is a resistance, right? Could be, 25 tops if you want. Doesn't matter. It's all the same principles. Is it the reason why institutions do not trade at smaller time frame? Because it takes time to develop a fundamental idea. Yes, that's part of the answer, but also there's too much noise on the smaller time frame. When you are in 1 hour, 4 hour daily, the movements are, there's less noise and the movements are less more clear. So the institutions prefer to trade on those time frames. When we are on a lower time frame, let's say 30 minutes, 15 minutes, 5 minutes, they are going to have the quant guys, right? The robots who are going to trade those time frame where there's more movements, more noise, and that's going to be based with, algorithms. And basically for us, we cannot do anything with that, okay? Can we also say those support resistance are what we call demand and supply zone? Yes, it's synonyms. They all mean the same thing. Demand, supply, accumulation, distribution, support, resistance, all the same thing. How do we explain a breakout, then retest, then continuation? Is it an institution move to fake out people? Do you mean like something, let's say, like you have a breakout, retest, and we continue? Is that what you mean? That's not to bait people. That's just to give a chance for traders to enter in the trade. So for example, when you have your breakout, okay, and then you have your pullback here or retest or whatever it is, this is a chance for the rest of the traders to enter on the movement. That's it. It's just like if I take the same example as before, you want to ride on the train. Just before the train leaves, 1 minute before, you might hear an announcement in the train station, train about to depart to whatever destination, leaving in 1 minute, last call. This is the last call. The train is about to go. Accumulation distribution concept, is it the same as Wyckoff method? I don't know what is the Wyckoff method, but it's not a method. It's just something that's universal in the market. So it's not someone who invented that. I did not invent that. It's just something that happens in the market naturally. Why do institutions give people a chance this last call? Maybe they give that last call to themselves. Honestly, I would not know that answer. You would have to find an institution and ask them. All right, so let's continue. Okay, still market structure. Now we will get to the chart. So we understood the concept of accumulation and distribution. Now let's get to our key levels on the daily and 4-hour time frame. So what are key levels? What are they useful to do? So we are going to highlight the most important support and resistance zones on our chart with key levels. Daily key levels line will be full lines and will be useful to outline our trading area. And H4 will be dotted lines, just so we can, differentiate them, and will be useful to identify obstacle for partial profits adding position. The goal when you trace those key levels is to touch as many zones as possible. So we have a clear indication of the most important levels on our chart. This will help us understand the market movements. So pretty simple, looks like this, okay? Basically, you would put your chart on the daily time frame, any currency, whatever you're analyzing, and you will find the levels that there is the most support, resistance, like this, like this one here, and you will trace just full lines like this. So you have, on your chart displayed the most important levels. And this process, it takes, I would say, not even 1 minute. Okay, if I show you just an example. So let me remove that. So basically, if you open a chart, do you see the chart fully, or is it cut off on this side? Full? All right, okay. So let's say I take let's put that here. Let's say I take GBP, GPY. I go on the daily time frame, right? The price is right over here. So I will put, you don't need to go back in time, go to 2017 to trace all your key levels. You can just go on your most recent area, maybe the last 6 months, maybe the last 12 months, just around the current price. So the current price is here, right? So maybe, from here to here, this is where you want to put your key levels, okay? So let's remove that. And basically you will take your tool and you will just trace them. Okay, you want to touch as many points as possible. So here we have 1, 2, 3 points. Here I can put 1, 2, 3, 4, 5. Here I have a key level 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Here I can put 1, 2, 3, 4, 5, 6, 7, and basically you do that for the whole chart. So it would look like this, and you can even put one here if you want, since it's the lowest point in the last few months. Okay, so that's your daily key level. So you see, it takes like 5 seconds. Then when you finish your daily key levels, you do the same thing. But with the 4 hours. Okay, so the 4 hours, you go in the 4 hours with the same principle, but you will put the dotted lines like this, so you have your chart even more dissected. And each time the price is going to touch either the 4 or the daily key level, you are going to know that there is going to be some sort of reaction. And of course, the daily key levels are going to be way stronger, way more important to look at than the 4 hour. The 4 hours can be, I would say, the price can go through the 4 hours, the 4-hour key levels way much easily than the daily key levels. So what's the point of doing that? Why are we doing that? Number one, okay, wide open space. Okay, so we can identify our wide open space. So the wide open space is the space between two daily key levels. They can range from 100 to 500 pips. Okay, it's like your play area. Okay, if you're playing soccer, if you're playing basketball, if you play baseball, you have your area that you can play with, and if you go outside, you are out of bounds. It's the same principle. The wide open space is your play area, so you must understand the borders of the market to be able to make good trades. Your goal is to always verify that you have enough space. You must measure the distance between the current price and the next daily key level and make sure you have at least 90 pips of space. If there's not enough space, you have to wait for the market to break the daily key level and go to the next wide open space where you will have more space to make your trade. So very simple. An example right here. So here I have all my key levels. Let's say the price is right over here and I want to short. Okay, I do my fundamental analysis, I do my technical, I do everything properly. But before doing my trade at the end, we see it right now at the beginning, but it's going to be more useful at the end. You want to see if you have enough wide open space for your trade to go and not, hit the price doesn't hit a big obstacle. Okay, and here when I measure the distance between the current price and the next, key level, I see that I have 184 pips space in front of me. So is it enough wide open space to make my trade, to have the price run? Yes, absolutely. It's more than 90 pips. Does it mean that I exit the trade here? Not at all. Your take profit could be here. Your take profit could be there. Your take profit could be all the way here. It doesn't have to do anything with the take profit. It's just a way of not entering a trade and getting either in a drawdown if you're too close to a key level, or if the price, has difficulty bouncing it. Basically, if you enter before 90 pips, you can always protect yourself, put your stop loss to break even. And if it decides to bounce and you break even, you have space to play with if it decides to bounce back. Okay, if you're too close, you will get stopped out if you put your stop loss to break even, or you will be in a drawdown if you enter too close. So if you entered here instead, the market goes against you, you're going to be in drawdown of maybe 100 pips, and then maybe you were right and the market will continue in the right direction. But you want to skip the drawdowns as much as you can. So this is a good example. Now, this is a bad example of wide open space. So let's say I want to go long here for whatever reason. You see, I have only 20 pips space in front of me before the next obstacle. Okay, so that means that there's a high probability that it does the same thing as before and it bounce back. So it might bounce back here and then go back up. And my trade was right, the direction was good, everything was good. However, if I entered here, I would have a big drawdown for no necessary reason. Okay, so we want once again to not skip that part of the drawdown. Okay, so what do you do when you're that close to a key level? Okay, two choices. You either wait for a retracement, you enter when there's more space, okay, or you wait for the price to break to the next wide open space. So let's say that was number one, you wait for it to go to number two, maybe you enter here, and here you have more space. Okay, so you have to be a bit creative. It depends on each scenario. So very simple. Now psychological levels. Okay, just quick section. I'm not going to spend too much time here. So psychological levels, very simple. They are round numbers in the market. Okay, so basically, the price must finish by 3 zeros to be considered a psychological level. The more round the number is, the more zeros there are, the stronger the level is. Okay. So since humans are logical creature, for the most part, they like to deconstruct the market in symmetrical segments and trade on those levels. Okay. So for example, let's say GBP at 130.000. I have 1, 2, 3, 4 zeros. So do I have more than 3 zeros? Yes. So this is a psychological number. It's a round number. This will be a support level to watch out for. Okay, so once again, this is just a concept that you need to know, and that you can expect support and resistance. You can expect some rejection at those psychological levels. So when you're about to make a trade, when you are in a trade, you need to keep that in mind and adjust yourself if needed. Here, Euro USD 1.25000. This is a psychological level, this is a psychological level, and this is a psychological level. The more zero there are, the more round number it is, the bigger the support is going to be. So this support, let's say we have two supports. This one has 4 zeros, this one has 3 zeros. This support, which is a big support that's going to happen, let's say this one is a medium support. Well, this one is going to be, of course, larger, more important, and going to have more reaction since it's a bigger round number. Okay, so very simple. Once again, it's a concept that you need to understand and use every day when you look at the chart. And that's it for the market structure. Is there any questions regarding that, regarding the key levels and psychological levels? How often do you refresh the levels on the chart? Very simple. You see the prices here. You see I put my key levels in this zone. I refresh my key levels and my zone when the price is outside. So when the price reaches, beyond that range, I can redo my key levels. Simple as that. Like gold 1800, yes, 1800 on gold is a psychological level. Do you highlight psychological level with different color? Personally, I don't do it. If it helps you, you can do it, right? There's no rule. You can do whatever you want. But no, I don't. I just look here on the right, and you see it. You see you see the numbers, and you keep that in mind always. What does it mean when your psychological level coincides with a daily or 4-hour level? It means that that level is going to be very solid, that you're going to have a high probability of having a support resistance at that level. Do we wait for candle closure above or below daily whenever before entering a trade in the play zone? If you, like I said, let's see here, I wanted to make a trade long. I wanted to buy GJ. I would measure how many pips. So if I measure from the current price to here, I see that I have 98. So technically I have enough space. But let's say I did not have enough space. What I do, I would wait maybe for the price to go lower here, okay? And from here to here, I would have enough space, okay? Or I would wait for the price to break out here, okay? I don't have to wait for the daily close to enter there. I can just look at it in, let's say, in 1 hour, and then I can find an entry point here, technical entry. And if my vision is to go here or here or here or here, it doesn't matter. I can make my trade up to my take profit. All right, so let's continue, okay, with this very important section, okay, trend and identification in daily, 4-hour, 1 hour. So pay extra attention here, please. It's going to be very important. So now that we traced our daily key level, 4-hour key level, okay, the next step is to identify the trend of the market on 3 different time frames to understand the story behind it. You will look at the last 2 highs and the last 2 lows to identify your trend properly. On the daily time frame, you're looking at the big highs, big lows. On the 4-hour time frames, you look at the medium highs and lows. On the 1-hour time frame, you're looking at the small highs and lows. Okay, higher high, higher low equals uptrend. Lower high, lower low equals downtrend. Okay, if you have any other combination than these two, it's automatically a consolidation, which means there's no trend. Okay, usually traders are are going to assume that on the market there's only one trend. Okay, they will say GJ is in an uptrend. Well, it's not true. There's a trend for every time frame. So technically, since we trade 3 time frames, the 3 principal time frames, there's 3 trends that we need to look for and understand. So there's never one trend on the currency. There's multiple trends going going on at the same time on multiple layers, okay, of the multiple time frames. So for example, here I have a daily trend or a daily chart. I want to look at the daily trend. And basically here you would look at the last big highs and big lows. Okay, so if we just look at how you would identify it, it would look like this. So you start always from the current price. Okay, you go to the last high, which is this one. Then what is the lowest low after the last high? Well, it's this one. What is the last big high after the last big low? This one. And then the last big low after the last big high is this one here. And then you see that we're making lower highs and lower lows, which means we are in a downtrend on the daily time frame. Okay, so since we are on a daily, you don't look at the small, levels like here. Okay, this is going to be more for the 4-hour or maybe for the 1 hour. You need to look for the big highs and the big lows for the daily. 4-hour is going to be medium, and 1 hour is going to be the small highs, small lows. So here, same chart, but we zoomed in 4-hour. Okay, so same thing, you do it again, and you come up with this conclusion. Okay, so the last medium low from this price is this one here. Last high is this one. Last lowest low, last highest high, which means it's a uptrend. Okay, uptrend. And if you find it a bit confusing right now, once again, the more you practice, the easier it will become. You do this exercise 20 times and you'll do it in maybe 5 seconds. It's very easy. You just need to practice. And then in 1 hour, okay, same thing. Look at the last 2 highs, last 2 lows. Here we're making a lower high. Here we're making a higher low. So we have a consolidation. We have like a triangle of some sort. Okay, we're not an uptrend or a downtrend. So this is very weird and very confusing and very special, because daily we're going up, 4-hour we're going down, and 1 hour, well, we're just in a range. Okay, so basically what's going on? Where is the market trying to go? Is it an uptrend? Is it a downtrend? Is it a consolidation? Should I go for a long? Should I go for a short? What's going on, right? We need to understand what's going on. So then we get to the most important part of your technical analysis, okay? I will write it down, most important part. This is the most important part, and you see we did not even look at the fib, we did not even look at the trend lines, we didn't even look at the entry points, we didn't even look at all of that. Because if you master this, the rest of the tools, the trend lines and the fibs and the indicators and all of that, that's so much easier and so easy compared to this, that you need to master this part firstly. So now we are going to make the bridge between the chart, so the technical analysis, and our fundamental analysis. This is extremely important. You will now link your chart with your fundamental ideas, okay? So very simple. What you have to do is you have to explain fundamentally the reason behind the trends on our 3 time frames, okay? On the daily time frame, you will take all the fundamental information. You will take your fundamentals idea, or if you had one fundamental idea that you have amassed in the last 3 to 12 months, it's a large period of time, it's a daily time frame, and explain why we are in the trend that was identified. So basically, the example that we did, it was a downtrend, right? So you need to explain why on the daily time frame are we in a downtrend. Okay, what's the reason why? What's the fundamental reason? On the 4 hours, same thing. We were in the uptrend. So we need to explain why on the 4 hour we are in an uptrend. What happened in the last 4 to 12 weeks that created that uptrend on the 4 hour. And then in 1 hour, we have the consolidation, we have the range. You have to explain what happened in the last 30 days that explains that consolidation. Okay, so you need an explanation for every time frame that you look for. Okay, so daily, one explication, 4 hour, one explication, and 1 hour, one explication based on the fundamental information you have amassed. Okay, so basically to do this properly, you need to be at least, okay, accumulating information for at least 12 months. Okay, so from today that we finish the course, it's going to take you 1 year to start, okay, to master this part. In 1 year, you will have enough information so you can explain all the 3 time frames really properly. If tomorrow you open your chart, you analyze the time, the trends of the different time frames, you're like, all right, let's make the bridge. Let me try to understand what happened 6 months ago. Well, you don't know what happened 6 months ago. So you cannot explain the trend. Why is it in a downtrend? Okay. That's why it takes time, and you have to put in the work and just be patient and accumulate that information. Right now, you're starting from scratch, and of course, it takes time. So once you have the explanation for every time frame, what do you do? So now that you have explained and understood the trends identified previously, you have to solve the puzzle and predict the next market move. Okay, so solve the puzzle. Okay, so basically you have to connect the dots between the 4 hour, the daily, and the 1 hour. And this will give you your answer, right? Very simple. How can you solve the puzzle? The market is changing and evolving all the time, which means each scenario is a unique case, of course. However, you can ask yourself the following questions to guide you, okay? Is there a problem, conflict, negative situation with the currency pair analyzed on the daily time frame? Then you explain the fundamental reason. Is there a problem? Yes or no? Why? What's happening? Okay. If yes, is the problem solved? And if solved, is it temporary or forever? In which time frame was it solved? Okay, was it solved 4 weeks ago, 6 weeks ago, 8 weeks ago, or was it solved 3 days ago? Okay. Is it a correction or reversal? And you need to identify when that happened, okay? Not necessarily the exact day with the exact hour, but maybe that week, that's where the problem is solved, maybe in those few days, something like that. If not, if there's no problem, is there a problem coming up? And is it a problem coming up in the short, medium, or long term? What is the importance of this problem? Make the link with your time frames, continuation or reversal with time perspective, which means is it short term, medium term, or long term? All right. So this might be a bit confusing, right? It's a bit more advanced, I guess, than just a basic fundamental analysis. But we'll do an example, and you will understand. So let's do an example here. Let's say the daily is a downtrend, the 4 hour is an uptrend, and the 1 hour is a downtrend. Let's say that's your situation. You ask yourself the first question: is there a market problem with my daily time frame? Was there something that was happening here a few months ago that created that downtrend? Yes, there was a problem, and then you explain the problem, okay? So the problem could be anything, okay? I could say coronavirus. I could say a problem between US and China. I could say Kim Jong-un launches a bomb attack. I can find anything. It doesn't matter. The problem is always going to change, but the principle never changes, okay? So yes, there was a problem on the daily time frame, which explains this. Okay, perfect. Was this problem solved in 4 hours or 1 hour? So is the problem still relevant today, but is it solved, forever, temporarily? So in this case, you do your fundamental analysis. You find out that yes, it was solved in 4 hours. Let's say you remember 8 weeks ago, in that period of time, that problem, the coronavirus, we found a vaccine, and let's say the problem was solved, and basically that caused that uptrend on the 4 hour. The twist here, it was that it was temporary, okay? The solution was solved temporary, but the problem came back the last few days in 1 hour. So let's do the example with the COVID. Okay, so there was this big pandemic going on, solved. Why? Because let's say there was a vaccine, okay, but temporarily, because the last few days we have a mutation of the virus, and now the vaccine is irrelevant. It doesn't work anymore. Okay, the problem came back. So now it explains my downtrend. Okay, final answer. The H4 uptrend was a correction. Yes, was a correction because it was the problem was solved temporarily. But now the daily downtrend will resume since the problem hasn't been fully solved. The market has no reason to go up. The 1 hour downtrend is the beginning of the continuation. So the mutation is the continuation of the daily. This is the continuation of this. The market is going down, right? Beautiful. That's how you do the puzzle. Okay, so it's a puzzle every time. And this is the process that you have to take. Like I said, the problem can be anything. It's always going to change. In 2020 is going to be something. In 2025 is going to be something else. In 2030 is going to be something else. But the principle is the same. Let's do another example. So daily, let's say I have an uptrend. 4 hour, I have an uptrend. 1 hour, I have a downtrend. Is there a market problem on the daily? No. There was no problem, everything was good. That explains the uptrend. Perfect. Is there a market problem in 4 hour? Nope, no problem in 4 hour. Everything is good. The 4 hour is a continuation of the daily. No problem. Is there a market problem on the 1 hour time frame? Yes, there's a problem. Okay, that explains the downtrend. Okay, but what's the problem? Then you explain what's the problem. Like I said, could be anything. Now, what is the duration of this problem and its importance in relation to the 4 hour and daily? Is it a small problem that's going to last a few days? Is it a big one? Is it something that's going to hit the market and reverse everything? What's going on? So you do your thinking and you find out that the problem is big, will last for at least a few months and could affect multiple currencies. Okay, let's say there was a civil war. I will take the example we did yesterday, civil war, okay, in China. Okay, the problem is big. Yes, indeed is big. It's going to last a few months. I would even say maybe a few years, and it will affect multiple currencies. Okay, that's the information, that's the situation. From my first fundamental idea, I just work it again with the time frames. Final answer, the 1 hour downtrend is the beginning of a new trend. The 4 hour and daily will follow. So the downtrend will slowly get in the 4 hours. So the 4 hour is going to become a downtrend, and eventually the uptrend of the daily is going to be canceled with enough time, and it's going to become a downtrend. So that this whole section here, right? This is AAA trade. This is 500, 2,000 pips trade. Why? Because the bigger time frames are affected. And since you're able to grasp this this movement at first on the 1 hour, you will have like a small stop loss. Let's say this is your entry point, and then you have a big take profit. Okay, because on the 1 hour, the movement is pretty small now, but it's going to evolve and last multiple months. You have confidence in your trade, and that you're not going to be making 50 pips and then your trade is going to be over and that's it. Okay, that the situation is so big, you want to go for that 500 pips. If you want to add position, you might even go to that 1,000 pips. If you're patient, you want to let the trade run for 1 month, 2 months. Okay, but with the bridge, the size of the trade, the duration, what you can expect, you have the confidence, and you can basically get your whole mindset, your whole preparation about the trade, you can get it right. Okay. Here's another example. We're not going to do it. You can read it at home on your own time. And that's it for the bridge, okay? Is there any questions for that? Like I said, that was a very important part. You need to understand it perfectly. Would you say that institutions trader do exactly the same? Yes, they do the same concept, the same principle. Okay, they might not use the same words, they might not use the same, structure in terms of how I put it there, but the thinking process in their head is the same, exactly the same. Actually, let's do the last example. Okay, you can write down your question while I do the last example, but I want to do it. Okay, so let's say daily downtrend, 4-hour uptrend, 1-hour consolidation. Is there a market problem on the daily? Yes. Okay, I have my downtrend explained. Was this problem solved in 4-hour, 1-hour? Was solved in 4-hour permanently? Okay, and you explain why. So you explain why was it solved permanently? What's telling you that? Okay, and then 1-hour. Is there a problem with my fundamental analysis? Do I see a problem with the 1-hour? Yes, something unexpected happened and the previous problem resurfaced. Okay, so even if it was solved permanently, something happened and now the status is not permanent, it became temporary, right? So the status has changed. Okay, it was unexpected. And now the 1-hour is not in a downtrend. Okay, it's a consolidation. So why is it a consolidation if the problem came back? Okay, final answer. The 1-hour consolidation is due to financial institutions having to suddenly change their plan due to the unexpected event. Let's say no one could have predicted that. They cannot just go like that into a downtrend. They were in an uptrend before. Okay, the change of the plan suddenly, okay, means that they are closing their previous position. So we have some distribution and they are preparing their plan for the future downtrend. So they are gaining time, right? So they're gaining time so they can build their plans, and that explains the consolidation. The price has not gone yet. They're gaining time, but you as a trader, you understand everything that's going on. That I would say it's a 4A, fourth A trade, I would even say, because that's like a 99%, accuracy trade. Okay, if this situation doesn't change, okay, this is going to become a downtrend. This is going to become a downtrend. It's not my opinion, it's absolute. Okay, I have too many layers of information and confirmations to not make that trade. Okay, so actually these types of situations are the best because, like I said, I have 99.9999% chance of succeeding that trade if I enter correctly and don't and structure my trade correctly. All right, back to the questions. When you said check if there's a fundamental problem in 4-hour, how can that problem only affect one time frame but not the others? It affects everything, but it affects the trend that is created during that time. Okay, since the daily, let's say you can have a downtrend on the 4-hour, but on the daily time frame you can still have an uptrend because it takes time for the daily time frame to change from an uptrend to a downtrend. It might take 6 months for that switch to happen. But during those 6 months, basically, let's say 3 months, the last the beginning of the 3 months, the 4 hour was in a downtrend, but the daily has not caught up yet. What if we keep having mixed info? How can we be sure 100% of a strong problem while there are also good news at the same time? Okay, when there's a strong problem, if I tell you the pandemic, came came on the market in 2020, even if there's some good data, from certain countries, it's a big problem. There's no question about it. If the fundamental is mixed, like I said, you will shrink down your fundamental idea and you will put more focus on the technical. You will make smaller trades. You're not going to be making a trade of 500 pips. Like I said, you're going to be making maybe a trade 80 pip, 75 pip, 100 pip if you want to trade, or you just wait it out and you wait for the fundamental to come back, normally, so you can do this part properly. Okay. If daily and 4 hour are uptrends and 1 hour is downtrend, how do you know that it is really a problem that will cause market shift and not just a small retracement in 4 hour uptrend? Is the only deciding factor the fundamental in that situation? Yes, like I said, it depends on the size of the problem. Okay, let's say daily was uptrend, 4 hour uptrend, 1 hour uptrend. Okay, something happens, the 1 hour is not the uptrend anymore, it becomes a downtrend. You go to find out why. You see, it's because a pandemic has hit the world and every business is shut down. Okay, 100% chance that this 4 hour is going to become a downtrend and this daily is going to become a downtrend. There's no question about it. Okay, it's a fact. You see the size of the problem, you know it's going to affect the other currency. If it's a small baby problem, maybe it's not going to reach the daily, maybe it's just going to affect the 1 hour. If it's a medium problem, it might just affect the 4 hours, the 1 hour, the 4 hour, and not the daily. Okay, so it's your job to find the size of the problem. And yes, it's fundamentals. Yesterday, we were looking at multiple fundamental indicators on employment, quantifying their potential impact and adding them up to set up an overall fundamental idea. Do you do this exercise across multiple indicators for all 3 time frames? No. The bridge here, okay, between technical and fundamental analysis is going to be based more on the headline news, okay? The calendar, the economic calendar is going to be more on the short term, on the instant that it exists. Okay, so maybe the effect of the economic data are going to be felt in the market for maybe a few weeks or maximum 1 month. Okay, but when we make our bridge and we look at everything, I would say 90% of that information comes from the headline news that we read, and basically the 70% of our fundamental analysis. Since it takes months to adequately amass the data for high-level knowledge of a specific pair and its fundamental, that is why you mentioned yesterday a gradual increase in success rate when new pairs are added to one trading repertoire. Yes, you will have an increasing success rate, but I don't understand when you say new pairs are added to one's trading repertoire. But yes, the more knowledge you amass, the more fundamental you build in your fundamental bag, the better your trades are going to become. Okay, like I said, it's going to take you about 2 years for it to reach a good level. For COVID example, because it affects every country, how do you know which one is going to affect the most if it ends up affecting everyone? Well, in your fundamental idea, that's your job to find the nuances between the different countries. Which countries is the more economically impact? So look at the numbers, look at the economic calendar, okay, look at the headlines. which ones are, have a population that respects the quarantine and the conditions and have a, high probability of bouncing back fast, and which countries are, ignoring the pandemic and doing whatever they want, and the business they have been opened and then they reclose, and then the government opened the business back again and now they reclose everything. That's the subtlety and the nuances that you find when you do your fundamental analysis. The more you read, the more research you do, the more time you spend, all those types of questions, of technical details questions, you're going to be able to answer them by yourself. Is 2 hours a day reading headline news okay, or should I have many news app with notification on and stay on top of everything right away? 2 hours is plenty enough. I don't even put 2 hours myself. I would say I would put between 30 minutes to 1 hour, okay? Because you do it every day. So if you put 30 minutes per day and you do that for, 365 days, at the end of the year, that's a lot of information that you have, in your head. Do institutional traders from different institutions all trade a relatively similar strategy? Yep. They're going to have different cultures inside their own banks, but it's pretty much all the same. Do they trade together or against each other? I would say both of them. Do they know they are trading together against each other? Yes and no, because since we are all trading together, well, the same way, I would say, they don't need to talk to each other to make the same trade. It's like, I have some students who I talk to sometimes, and they talk to me about their trade that they did, let's say 2 weeks ago, 1 month ago, 2 months ago. They show me their chart, and I did exactly the same trade as them. We have exactly the same fundamental analysis. We have exactly the same chart, the same entry point, the same stop loss, the same take profit, and we did not talk at all during that period of time. And just because we trade the same, we had the same thought process, so we made exactly the same trade. It's the same thing with the institutions. If you only trade the 6 pairs, are you looking at the headline news for the major countries, not creation to pair like US and China? You look at everything. You look at everything, okay? Maybe you're not gonna look, what happens, with the CHF, because it doesn't matter with our currencies. But yes, you will look at US, you would look at China, you would look at anything that affects the 6 pairs. All right, so let's continue. So now, creation of the technical idea. Now that you know the direction of the market and you understand exactly why, the next step is to identify the best technical points to enter a position and get in the trade. You know the direction, if it's up or down, you know exactly why, you know what's going on, okay? You know if it's a small, medium, long-term trade, are you going to go fishing for 100 pips or 500 pips or 250 pips or maybe 2,000 pips on that trade, okay? You know the scale of the trade. The only thing that's remaining is, where should I enter? Should I enter here, or should I enter there, or should I wait for a retracement here and enter there? Those are the entry points that you need to find with your technical idea. So how are we going to do that? How are we going to find those entry points? With the help of trend lines, counter trend line, key level trend lines, channels, and counter channels. Okay, they're pretty much all trend lines. They all have different names, but it's the same thing. You could, in principle, enter the trade at any moment without a full technical analysis and have a good accuracy rate, since you know the future direction of the market. But of course, that is not optimal, because you're not going to have the perfect entry, and you're not going to optimize your risk, optimize your pips. So we want to construct the best technical idea to extract a maximum of pips from that movement. I can have a movement that is 500 pips, let's say, that I predicted with my understanding of the trends, of the fundamental, the market sentiment, the price action, everything, okay? But let's say I enter in the middle here and I close my trade here and I only take 150 pips. That's really not optimal. I was right, but that's not optimal. So the goal here is you optimize the trade. So maybe instead of entering here, maybe you enter here. And here you add the position, and here you add the position, and you exit here. So that 500 pips has now become, let's say this one was 400, this one was 250, this one was 150, and basically your exit was there, okay? So you take that 500 pips movement, and then you have 400 plus 250, since you open the same lots, you always have the same lot size, plus 150, right? So basically you have 800 pips, okay? You made a magic trick from the market. You took 500 pips and you magically made it 800 pips with your proper technical trade, your proper execution. And that's beautiful because you can take more pips than what the market gives you on a 500 pip movement. The guy that entered here and exit there, that made, let's say, 150 pips, you made the same trade. And let's say, Bob here and Mike here, they followed the same course, they followed the course this weekend, but Bob is not really good with his technical. Mike is very good with the technical, but the fundamental, they are on the same level. They made the same conclusion, they had the same direction, they made the same conclusion, they solved the puzzle the same way. But Bob is going to be way less profitable than Mike because Mike knows how to optimize, optimize the movement, okay, and makes more pip. So Bob has to make, how many trades? So basically like 5 trades, a bit more than 5 trades to make the equivalent of 1 trade from Mike. Mike will compound, his account very fast. Mike will have 20% return on his account each month. Bob will only make 5%. Okay. Mike is going to grow his account, and since it's exponential, Mike is going to be light years ahead from Bob. Okay, even though they know the same thing. So the technical is very important, but you need to master all the previous stuff we saw up to now. So there are 5 types of trend lines, which are all part of the same family. They will be used exactly the same way, and we will draw them in daily, 4 hour, 1 hour. Okay. So I'm not going to explain what is a trend line. Okay, you should know that. However, there's 3 rules to follow for tracing the 5 types of trend lines. Number 1, you must draw the trend lines on the wicks as much as possible. You must touch as many points as possible in your trajectory, even if it goes a bit against rule number 1. And your trend line has to be useful for the current or future price. There's no need to trace a trend line that is not useful for a future trade. Okay, so trend line, counter trend line, key level trend line, channel, counter trend channel. Okay, you should pretty much know all of them except this one. Maybe you're not familiar with. So a key level trend line is a line that doesn't follow any trend but acts as a support resistance. Most of the time, it will slash through candlesticks, so it will go through the chart. So this is a regular trend line, pretty simple. A few counter trend lines. So those are trend lines that are against the current uptrend. Here we have a key level trend line. So here we're going to spend a bit more time. So here, this trend line starts here. We have, a resistance here, a support there, support, a resistance, support, here a bit of support. This is a key level trend line. It doesn't follow any trend at all, but you see it's very well respected, very precisely. So this is useful for us. We have another one here, resistance, 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 support, support, resistance, and support. So you see it's extremely precise, and these types of trend lines are my favorite. You have to be a bit creative to find them. Okay, so once again, practice, 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 but they are very useful. Channel, counter trend channel, same thing as a trend line, but you need to be parallel, okay, the same angle, and that's it. Okay, so here I put a full analysis with the trend line, daily, 4 hour, 1 hour. Okay, you can look at it in your spare time. Instead, what I'm going to do, I'm just going to do a live example. I think it's going to be more useful. So I just put this here. All right. So this is GJ, for example. So we are on the daily time frame, and you just trace all your trend lines. And like I said, it has to be useful for the current price or the future price. So if, let's say, I take a trend line and I draw a trend line here, okay? Is it useful? Absolutely not. Okay, it's useless. We remove it. But if you take the whole chart, okay, right here, okay, you will start to trace some trend lines that are useful. So you see in this case here, this daily trend line, it doesn't touch this point, and I adjusted it so it touches as many points as possible. Okay, if I were to adjust it with this low over here, okay, here you would have too much of leakage from your trend line. So I would put it like this, and the current price is here, so I will leave it at that for now. If the price decides to do a move, maybe I will adjust it like this, okay, depending on how the price reacts. So it takes a bit of concentration, so I'm not going to talk much. I'm going to try to see if we find some trend lines. And I think that's it. Did I miss a trend line on the daily? I can make this one a bit more precise. So then we go for hour, do the same thing. So sometimes when you go on the 4 hour, you'll do some small adjustments like this, to just be more precise, to really touch the end of the wick. And that should be good for the 4 hour. And then the 1 hour, we have a bit of consolidation, so there's not much trend lines. Yeah, I think that's it. We put some 4-hour trend lines that can be used in 1 hour as well. So that would be it. So that's how you trace your trend lines. So it took me maybe, I don't know, 5 minutes, something like that. That's when you get used to it. Maybe in the beginning, it might take you 10, 15, 20 minutes, but you go from daily, 4-hour, 1 hour, trace the trend lines on the edge of the wicks and touch as many points as possible. And you want to make sure that all the trend lines are useful for the current price. So the current price is, for example, right over here. The price goes up, you have an obstacle, here you have an obstacle, if you look down, you have an obstacle, here you have some space, here you have your key level, here you have some space. So basically you have all the possibilities displayed in front of you. And that's it, that's how you do it, okay? So now that you have traced all your trend lines in the 3 time frames, how do you find a technical trade and enter it? You have 2 options, break, hook, go, or big bounce. So break, hook, go, it's a known technique. It's very simple. Just I added the go. It's like a break retest. It's the same thing. It's universal. Everyone uses that. And big bounce, we're gonna see that shortly. Okay, but let's start with the break, hook, go. So break or go is when you have the break first, when a trend line, and what is a break? Is when a trend line with or without another element of structure, support, resistance, psychological level is broken, okay? The hook is when the price comes back on the broken elements and retouches it, okay? So basically we break, let's say I have a channel, something like that, break, this is a break, retest, okay, which is the hook, and then you have the go afterwards. Go is when the market confirms us that the price is bouncing back on the elements of structure. You will enter the trade after the go if we close below above the trend line, which means if we go back inside here, the break, hook, go is not valid anymore. Now, what is a big bounce? What's the difference with the big bounce? The big bounce is when you have a big, heavy rejection on the confluence of trend lines and elements of structure, support, resistance, psychological levels. We can also add the moving average that we're going to see just after. You will enter directly without a confirmation, okay? Make sure that your fundamental idea is solid and that the level respected for the big bounce is also solid. Sniper entry. So what does it mean to enter on a big bounce is when you have a confluence. What is a confluence? Is when you have multiple trend lines going at the same point. Okay, this is a confluence. It's like a spider web that multiple trend lines support, resistance, psychological level, moving average. They all, and we can even add, Fibonacci. Fib can be confluence. They all intersect at the same level, at the same place. That means it's a very solid place. It's a good place to enter your trade. You enter without a confirmation. It's a sniper entry. You just click on the button. You can also put a sell limit, a buy limit in advance, and it's a safe place to do so because you will always have an instant reaction. Okay, on the break, hook, go here, you cannot use the limit orders. You cannot put a buy limit or a sell limit. Here on the big bounce, you can because you just enter in the trade without a confirmation. You can put a buy limit, sell limit, and the confluence, you always see them in advance. So let's do an example for the break, hook, go. So here, for example, we have a chart, and basically here we have the break, here we have the hook, we have like a sort of double hook, double bottom here, double hook, and then here you would wait for your go. My goal would be maybe I would trace a counter trend line like this, and when we break above, it confirms me that the market wants to push above, and then I would enter somewhere, you know, here for the trade after. Okay, so it's like a break retest, but you just add the goal, so it's a way to enter the trade. It's a classic, it's universal, and it works. It's simple, and that's it. When you to enter the break or go or the big bounce, it should be, you know, the most easy part of your trading. Okay, because you did all the work before, put the trend line, you did the bridge, you did the fundamental, you understood all the concepts. Basically, now break or go, you wait and you enter at the go. So what happened afterwards? We broke here the counter trend line, and the market completed its movement. Now, big bounce, example for big bounce. For example, here you have a level of confluence, and I forgot some trend lines. You have this trend line here and this one here, which is like a channel. Here you have a psychological level as well. I don't know if you guys see it properly on your screen, but in the background you see some small gray lines, very subtle, very faded away. Those are round psychological levels. I'm just gonna highlight them like this, okay? And I have this trend line, 1, 2, this is the third point. I have this trend line, you know, just below that all connects at the same place. So basically I have 1, 2, 3, 4 elements of confluence. They are all crossing each other around this area. I can put a buy limit there in advance, or I can just put an alert, or, you know, just be in the front of the screen and just enter in a trade, big bounce, zone of confluence, and I do my trade. And we had a nice bounce, we came and retested, and we completed the movement, okay? Once again, this movement here, the cause of the movement is not because of the big bounce. The cause is because of the fundamental situation, okay? The entry is the big bounce, okay? The optimization of the trade is the big bounce. You don't just do a big bounce if there's a fundamental context, okay? If the fundamental is mixed or flat, there's no really cause, okay? So nothing is going on here, it's dead. Now you will put more focus on your technical. So yes, you will be able to, you know, find some confluence like that, find an entry, break or go, but you're not going to be making a swing of, you know, 300 pips like this. Maybe you're going to enter here, and maybe at the next resistance right over here, you're going to close your trade. You did 85 pips, you did 90 pips, you did 100 pips, you call it a day, okay? So you have to adjust yourself depending on the market conditions, okay? And that's pretty much it. So the break or go will allow you to have more confirmations to enter your trade, but you will miss out on a few pips since you are entering a bit later than a big bounce. The big bounce will allow you to have a perfect entry and maximize your pips. However, you do not have any confirmation, so you should be more careful and double check your analysis, of course. And you will have to juggle between the two techniques depending on the market conditions, your fundamental and technical analysis, and your trading experience. So to be successful at trading, you need to manage fundamentals, technicals, timing, risk, and of course, the emotions. So if I show you, for example, a trade I did this week on GJ, okay? So if we go back in time a little bit, right over here. Actually, let's go even before. So right over here, okay, I will show you a trade I made. I can adjust that a little bit. So right over here, have this GJ chart. I have the same trend lines. Everything is the same pretty much. And now we did not see the fibs and we did not see the moving average yet. But I still have some great confluence on this level here. And with this double top here, and I have also some head and shoulder, okay? So I have how many elements of confluence? I have one from this, two from the key level. Is this a round number? Nope, not a psychological level. Here I have the resistance here. So basically I can have, you know, my head and shoulder. I see my head and shoulder like this, but we're gonna see just in an instant. We did not see it yet. So my head and shoulder is my third element. And basically, we did not see the fib yet, but if you already know how to use the tool Fibonacci, you do your fib. You have some confluence with the 61.8, which is at the same level, right? So it's like a zone right over here, just like this. Okay, so I have 1, 2, 3, and 4 with the fib elements of confluence. So what did I do? I just placed a sell limit right over here. Okay, right in the middle. I could have put it a bit below, a bit above. The risk by putting it above is that maybe it's not going to reach it. So I put it, you know, just right over here. Okay. And basically that was my trade. Okay, big bounce, enter on the trade directly. And what happened? Price pushing up. Then the pending order got triggered. The sell limit was triggered. The head and shoulder has been completed. The reaction on the 61.8 happened. We had a bounce on this key level that we drew before, and we had you know, this trend line that was respected. So my trade was right over there. Then the market, we came to retest it a second time. So we have like some sort of double top, and then that's it. I have my extension and my trade was pretty much finished. Actually, I aimed for this level right here. So for the last, I took my profit right over here. Why? Because this was not a big fundamental trade. It was not something that, you know, would extend and go all the way down here. There was no fundamental activity that was big enough for it to push GJ all the way down. So I kept it concise, clean, and short. And basically from here to here, that's 100 pips. You know, very clean, very easy, very basic, just as an appetizer until the fundamental comes back to life. Okay. So this is an example I did this week, and this is basically how you will do your trades. And then we are here. So a bit of consolidation, and the market is here. So just before we go to the chart patterns, I'm just going to skip all the way to the end. And we're going to look at the moving averages, okay? Since I put it at the end, but it's in the same section. So moving averages are one of my favorite tools and will be used as elements of structures, just like support, resistance, or a trend line. They will be added to our confluence when we trade a break hook go or a big bounce, okay? So it's the same thing as a support, a resistance, or trend line. Can also be used as obstacles for partial profit or take profit, only useful in a trend because when there's a consolidation, they will become chaotic. And we will be using the regular 50 MA, 100 MA, 200 MA, and we can use it and we will use it in the 3 time frames. A moving average is based on the price average of the last 50, 100, 200 candlestick, depending, you know, on the settings that you put. Those settings on the moving average, by the way, are the settings that the institutions are using on their chart. So like I said yesterday, if you were to go and sneak in Goldman Sachs office in New York, look over the shoulder of a trader, look at their chart, you would see the 50, the 100, and the 200 MA. You might see the 400 MA as well, but for us, it's too big. It's not really relevant. So financial institutions use these exact MA. They are a big part of their trading. And just some example here visually so we can see how it looks like. So you see here, respects the moving average. Here it acts like a resistance. So if you have some confluence with some trend lines, some key levels, some stuff like that, this could be a big bounce. You can find some break hook goes sometimes. So basically you treat it the same way as you would treat a trend line or a key level or psychological level. Okay, it's the same level of importance. So resistance here we have a support, big zone of resistance on the MAs. Here we have some sort of break hook go, small baby break hook go. Support. Here we have a clear break hook go of the 50 MA. We break under it, we come retest it, and then the market continues, does the same with the 100 MA and pushes through. And here are some resistance, some support. So you see, they are very solid. Here, same thing, support. Here we have a break hook go at the end, break, hook, go. Okay. When it reaches the 200 MA, bounces off because it's an important level. The institutions are trading based on those moving averages. So, of course, they are going to be respected. And that's it for the moving averages. So let's get back to where we were, to the chart patterns. So last section for the market trend before we take our break. Okay. Chart patterns. What is a chart pattern? It's a specific price action, just like the head and shoulder I just showed you on GJ, that has been formed in a specific shape and been repeated multiple times in the market over the years. They are used for three things. So we can use them for three things. Either to enter a trade, okay, with fundamental and other confirmation, just like the head and shoulder I just showed you on GJ. I enter the trade with that confluence. I can use it to add position to your trade if I'm already in a trade, and it could be a second chance to enter a trade if the right entry was, before. They will all be traded the same way, which is break or go or big bounce, okay, but only for the head and shoulder on the right shoulder, okay, which is a classic and nothing new here. But the rest, 99% of the time, is going to be break, hook, go. The chart pattern can appear in any time frame. However, sometimes to clearly see the break hook go, if it's too small, you will have to go in 30 minutes or 10 minutes, okay? But usually it's going to be in 1 hour. You can find them in 4 hours, the big one, 1 hour. And if the break hook go is too small, too little, you go on 30 minutes, 10 minutes, but that's the only exception to find your entry point. So here we have the patterns, the list of the patterns. I'm not going to go through them, one by one. But what's important to understand here is on this example here, forget the stops and the targets. They don't mean anything. Okay, just remember the name, remember the shape. And the entry point is good. So the entry point is where you will find your break, hook, go. Okay. Here, wedge, you can have a flag. You have break, hook, go upside, break, hook, go downside. Here you have a rectangle, break, hook, go upside, break, hook, go downside. Triangle, same thing, break, hook, go upside, break, hook, go downside, and so on and so forth. It's the same thing. So, like I said, the only exception is on the head and shoulder. That here, if you want to to enter here, you can enter on the right shoulder of the hand shoulder. But if you find a flag, maybe, I don't know, let's look at a flag like here. You have some sort of triangle here. It's an easy example. Some sort of triangle like this, like this. Here you have your break hook go. You see, it's too, we are in a too big of a time frame to find an entry point. So what do? You go down in 1 hour, for example. You find the place right over here. You have your triangle, pennant, flag, whatever you want to call it, it doesn't matter. And if I do it actually properly and we trace the trend lines, you can either put it like this. You have your break hook go here. And you can put this like this. Like I said, doesn't matter. Here you have your, let me remove that. Here you have your break. So here you have your break. Here, when we go back, you have your hook. And then here you have your go. You can enter here. And, you know, you have a nice continuation of the movement all the way down, of course, depending on your fundamental, technical, everything. Okay, you never just trade a triangle like that without any reason. It needs to be sustained with something else. Okay, but you get the point, you get the idea. And that's it for the chart patterns. So now, is there any question regarding the moving averages, the chart patterns, the break hook go, the trend lines, all of that? Question time. At what point would you remove the key level trend lines to prevent your charts from getting too cluttered? You don't remove them, man. That's the fun of it. You want everything to be there, and your chart will look like this. Okay. If you find this too cluttered, then you're not ready to be a trader. I'm joking, but at first it looks a bit confusing, but with time you get used to it. For the chart patterns, how come the financial institutions follow them if the info is available for the retail trader? Good question. The difference between our chart patterns and the chart patterns of the retail traders are none. There's no difference. The difference is in the application of the chart patterns. The retail trader can use trend lines, right? They can use key levels, right? But do they use them the same way as we do? Absolutely not. Okay. The chart patterns, if you only trade chart patterns without any fundamental context, without, you know, having a clue of what's going on, then you're a retail trader noob. Okay. If you have, you know, a situation where the chart patterns is a confluence with your trend lines, your key levels, with your fundamental, then it makes sense. All right. So that's the difference. We don't trade, actually, let me take the other tool. We don't trade chart patterns by themselves. Okay, never by themselves, never. That's what retail traders do. Okay, what do? We do fundamental plus bridge plus trend lines plus confluence, and maybe sometimes we find plus a chart pattern, and this gives us a good trade. That's the difference. Okay, if you trade only chart patterns, you're going to have maybe like a 30% accuracy rate, maybe a 20% accuracy rate. If you do all this, maybe you're going to have 80% accuracy rate. That's the difference. Do you recommend we trade breakouts or always wait for the retest? Always wait for the retest, always break or go. Your whole life from now on, you either trade a big bounce or break or go. You can change the name if you want. If you don't like the word big bounce, you can call it sniper mode. You can call it whatever you want, but it's always the same concept: big bounce or break or go. On your charts, we see that you have the daily and 4-hour MA at the same time. Can you show us which indicator it is? Very simple. You just write daily MA, right? And you can take any one actually, and that's it. Then you can change the settings here. You can actually, this one has 20, but you can play. I don't remember which indicator it is, but you play with them, and basically you can put them on at the same time. So you just write daily MA in the indicators on TradingView. Do MA theory have something to do with Larry Williams? I have no idea who Larry Williams is. And once again, the MAs are not something that people invented. It's just something that is universal, that every institution use. There's no, there's no creator of, of the MAs or the concepts of that. Yesterday you said when something is too obvious, it's too good to be true and probably a trap. Yep. And now we follow them and use them. Okay, I see. What do you mean, Susan? I don't know what you mean by that. Do you give moving average more significance in certain time frame? Of course, the bigger the time frame, the more the moving average is going to be important. The higher time frame, the stronger the moving average is going to be. With the correct fundamental bias, main idea, how many confirmation would be considered a good trade? I would say minimum 2-3 confluences to have a big bounce. On short trades with no strong fundamental bias, like 100 pips, like the example you showed of the head and shoulder, would you add position if the trade is going your way? Nope, you don't have, I will not add position because there's not enough room to add position. The main goal of counter trend lines, counter channels, well, all the trend lines is to find break or go and big bounce. So Michael, it's not just counter trend lines and counter channels, it's all the trend lines. And there's no preference between a break or go or a big bounce. It could be both of them. For the big bounce, break or go, should we also consider the stop hunt that institutions use to fake retail trader out? You always consider it all the time, okay? The difference is the probability of having a stop hunt on a easy, obvious setup is very high. But when you have something that is more complex, for example, this setup here, this one here, this one here, this one here, this one here, this whole trade here that we just did is not obvious. It's obvious now because I explained it and I used all the tool correctly. You take any retail trader, I do this, you remove everything, and you put the you put the time back, you put it here, or even before. Okay, you take any retail trader, you put it here. They might not do the trade like that. The difference between this and this is pretty big. So this is not an obvious setup. But the more obvious the setup is, the more chance of a stop hunt needs to happen. How come those MAs are flat? The flat MAs are daily MAs, but they are displayed in 1 hour. That's why they are flat, because it's like 24 candle is going to be one increment. So because it's a daily moving average. For the example you showed on your previous GJ, where would your stop loss have been? You will see when we get to that part. Do you use long-short ratio to have an idea when a stop hunt is likely to occur? What do you mean by long-short ratio? Do you mean like community outlook? Nope. Like I said, the community outlook is not very accurate. It's not based on the community outlook. It's based on the concept of your interpretation of of how obvious the setup is. So basically, each time you see a setup, you must ask yourself, from 1 to 10, how obvious it is. 1 being, let's say, not obvious, and 10 being very obvious. When it's very obvious, there's a high probability of stop hunt. When it's not very obvious, there's a low probability or even none. Okay, now you're gonna tell me, Sammy, how do I know if it's 1, 5, 10? Experience, 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 experience. That's it. If it's a 10, should I still trade or push back my stop loss? That's up to you. Is maybe you just wait. If you're expecting a stop hunt, you might just wait for the stop hunt to happen and enter after it. Or if you're more advanced, we're going to see it later on, you just don't put any stop loss at all. You have a stop loss on your chart, but you don't put a stop loss on your broker. So when there's a wick, you know, it happens very quickly, but it doesn't stop you out. It gets back to the regular level and you're protected that way. For example, 5-to-1 ratio in favor of long could show that institution will make a stop hunt play on the short side. It could, but like I said, don't base yourself on the community outlook. Base yourself on your ability to identify if a setup is easy to see if you put yourself in the shoes of a retail trader. Okay, and the more obvious it is, the more probability of a stop hunt it will happen. It will occur. When entering break or go, do you need to wait to candle close below previous level? It depends. You just wait for the market to tell you that you have the confirmation. Sometimes you have to wait for that candle close. Sometimes if it breaks a counter trend line, you can enter at that moment. There is no rules for that. It will depend every time. Do you recommend buy sell limit rather than just buy sell for big bounce? Yes, you can use both. It's personal. You can find a method that works best for you. If you prefer to be in front of the screen, well, just wait for the buy sell. If you're busy, you have you go to school, you work, put a buy sell limit, and that's it. It's the same thing. Do these stop hunts happen on a specific time of the day or just random? It's random. So for example, here on gold, we had a few stop loss, before. If I go on 4 hour, whoop. So here on gold, this is a stop hunt, this is a stop hunt, this is a stop hunt, this is a stop hunt. Here we have a close and reverse stop hunt under the EMA, stop hunt, stop hunt. They can happen at any time. Here you think you want a short, stop hunt. Here, it happens anytime, honestly. You just need to be careful if the setup is too obvious. All right, guys, so let's take a break. Okay, lunch break. And just like yesterday, let's be back in 45 minutes. So it's at 1:40. So at 1:40 p.m., let's be back and we'll continue the rest.